In capital budgeting, we are going to study replacement model. You may already have an asset supposed to be replaced in coming days. Probably the life of the asset may be 5. Already used 3 years or 4 years. Almost major days are over, or 50 years is also completed. Okay. Can we do some slight repairing and continue with the same, or can we go for the new one? That's what about the choice we have here. Replacement model. I'll solve the question number 15. Ditto the same like we have the next illustration, question number 16. So let's try to finish up 15 first and just repeat that with the 16th also. These two are the nice example for the replacement. Usually this replacement model may be expected at final level, but what can we do? We have this one also at inter level, same inter level, so we can include this for additional learning. Right. 9 Gems Limited has just installed machine R at a cost of rupees 2 lakhs cash outflow for machine R. Cash outflow at the 0th period being 2 lakhs. We have already installed. So 9 Gems Limited has just installed machine R at a cost of rupees 2 lakhs. The machine has 5-year life with no residual value. So life being 5, scrap value of this asset being 0. Okay. The annual volume of production is estimated at 1,50,000 units. Production per annum being 1.5 lakhs units. Already installed. Which can be sold at rupees 6 per unit. Selling price. Annual operating cost are estimated at 2 lakhs. Cost per annum 2 lakhs. We have not included the depreciation here. At this output level means for the production of 1.5 lakhs you will spend 2 lakhs rupees. Fixed costs are estimated at 3 per unit for the same level of production. Fixed cost usually should not be given in per unit level. If per unit basis fixed cost is given, always remember this fixed cost per unit is applicable for the given level of operation. So naturally the total fixed cost should be given level of operations multiplied with the fixed cost per unit 4.5 lakhs. This remains constant. If you produce more than 1,50,000 units or less than 1,50,000 units, the fixed cost remains same. Suppose if you produce only 1 lakh units, that time also your fixed cost being 4,50,000 rupees. So if we divide that by 1 lakh, 4 rupees 50 paise will be the fixed cost per unit. Usually fixed cost per unit is varying in nature. Right. 9 Gems Limited has just come across another model called Machinist. See, always it happens, right? You do lots of research. If supposed to go for purchasing a mobile or whatever it may be, you do lots of research. You waited for a week's period to find good mobile. The moment you purchase, the next day a new model may be released by the same vendor. Happens or not? Same happens here. After lots of research, he purchased the R. Installed. The next day, the manufacturer says, "Sir, we have new model Machinist." Capable of giving the same output. It will also gives you the same output. But annual cost is only 1,80,000. Sir, the machine R cost us 2 lakhs per year for operating, but this one is only 1.8 lakhs. You are saving by 20,000. Exclusive of depreciation. Of course, depreciation is not a matter. There will be no change in fixed cost, but fixed cost remains the same, 4.5 lakhs. There is no change in that. Capital cost of the machine is 2.5 lakhs, but this cost is 2.5 lakhs. And estimated life is for 5 years. The life is the same, no problem. Okay. And residual value is also 0. The company has an offer for sale of machine R. So you have already installed, and new model comes here at the rate of rupees 2.5 lakhs, where you can gain almost 20,000 rupees for operation every year. Then you tempted to move from R to S, but you already purchased. What can do? Dismantle and sell in scrap. That same happens here. Okay, the company has an offer for sale of machine R at rupees 1 lakh. So the old R, that installed one, of course new, but you want to shift from R to S. Naturally, what happens? You have to discard R. To dismantle and sell, you will get 1 lakh, and the cost of dismantling and removal will be amounting to rupees 30,000. From this, it is very clear you will get 70,000 rupees cash flow from shifting from R to S. As the company has not yet commenced operation, it wants to sell machine R and purchase machine S. Now tell me, is it advisable? Is it advisable? Can we shift from this one to that one? That's the question. See the further information. 9 Gems Limited will be zero tax company for 7 years. Zero tax. So tax is not a matter. If there is no tax, you never bother about the depreciation, because if there is any depreciation, first you subtract, calculate the tax, later you add the depreciation back. So if the depreciation is missing, minus depreciation, add the depreciation back, will have no impact. So in the absence of depreciation, taxation, you never bother about the depreciation component. Is that clear? You understand? So you never worry about that. So as this company being zero tax company for 7 years, we no need to worry about the depreciation too. The cost of capital, KO, being 10%. Advise whether the company should opt for the replacement. Now, in the case of replacement, what's your suggestion is the mode of working is very simple. What is the additional cost you spend because of shifting from one to the next? What is the savings because of shifting? Whether the saving is higher than the cost you spend, of course you can go. Because of shifting from R to S, okay, there will be incremental cost, there will be incremental revenue or decreased cost, or incremental revenue. Either it may be incremental revenue or decremental cost. The incremental revenue being 10,000 rupees, incremental cost being 5,000. What does it mean? Because of shifting from R to S, you are getting 10,000 rupees excess, but you are getting 5,000 rupees additional cost. Naturally, you end up with 5,000 rupees additionally in your hand. Definitely, you are recommended to replace this. Else, the other way, if the cost is 10,000 rupees and incremental revenue is 5,000 rupees, don't replace this. That's how you can give the answer. Similarly, in this illustration, listen, this is most important. Now, from this, what about the incremental revenue? You have to find out the incremental revenue first of all. Fixed cost earlier also 4.5 lakhs, now also 4.5 lakhs, there is no change. Is that clear? There is no any change. 1 second. Yeah. But because of shifting from R to S, instead of spending 2 lakhs, you spend only 1.8. There is savings of rupees 20. Output is also same, no impact. Selling price is also same, no impact. 1 lakh 50 into 6, 9 lakhs was the earlier sale. Now also 9 lakh sale. There is no any change due to the sales revenue. And fixed cost earlier also 4.5 lakhs. Now also 4.5 lakhs. There is no any impact. But the operating cost from 2 lakhs, it reduces to 1.8 lakhs. That's a decent savings of rupees 20. Definitely we can recommend this one. Now, incremental revenue being 20,000 rupees per year. For how many years? It happens for 5 years. The incremental revenue will be present value of cost savings. You have to find out this. Okay. Otherwise, this way 20,000 rupees is the incremental revenue per year. For how many years? 5 years. Then you need to find out the annuity factor for 5 years. Annuity factor at the rate of 14% for 5 years being, come on. What's the value? 3.43. Okay. Can we round off with 2 digits or 3 digits? Hmm? If you make it 3 digit, 432, right? 432. Now 3.432. What is the ultimate cash inflow? This is what about the summation of discounted cash inflow. Summation of discounted cash inflow. 68,640. From there, you have to subtract the cash outflow to find out the NPV. To find out the NPV. What is the cash outflow? In order to shift from RPS, okay, for shifting from RPS, you need to spend for purchasing yes 2.5 lakhs. But already you installed R, you no need to have the R, so you can dismantle and sell. If you dismantle and sell, you will get how much? 70. Cash inflow at the 0th period because of dismantling and selling R 70. So today you are in need of how much? 1,80,000 rupees only. This is what about the cash outflow, net cash outflow. So if you are spending 1,80,000 rupees, by spending this one, you can simply shift from RPS. Over the 5 years period, you will be getting 68,640. Naturally, the incremental cost of the project is higher than the revenue. By how much? 1,11,360 negative. So definitely this replacement is not advisable. This replacement is not advisable. Is that clear? Clear? Now, see here, second question. Will there be any change in your view if machine R has not been installed, but the company is in the process of selecting one or the other machine? Then it becomes mutually exclusive. You are not installed. You go for verification. There are two machines, R and S. I am asked to consider between these two which is the better. Then mutually exclusive. Okay, so we'll go for that. In case of mutually exclusive, find out the NPV for both the projects. Is that okay? Now, sales for machine R, for machine S. What is the sales revenue? 1,50,000 units. Per unit cost us 6 rupees. 9 lakhs is the sales. Whether you sell using produced from R or produced by S, you will get the same sales revenue. Minus, you have to subtract the variable cost. Variable cost for project machine R being 2 lakhs. In case of machine S, the variable cost being 1,80,000. You are saving around 1,20,000 rupees. Apart from that, you have to incur the fixed cost. The fixed cost at the rate of rupees remains constant for the given level of production. So 1,50,000 into 3, 4.5 lakhs is common in both the cases. Machine R or machine S, whatever the machine you install, your fixed cost being the same, 4,50,000. And of course, depreciation is irrelevant as zero tax scenario exists here. So then your profit being, cash inflow being, come on, 2.5 lakhs. In this case, the cash inflow being 2.7 lakhs is the cash inflow. Now you have to find out the summation of discounted cash inflow by multiplying this with the anti-factor. The anti-factor in this case being 3.432. For machine R, 2,50,000 rupees will be your cash inflow per year. For 5 years after discounting at the rate of 14%, your ultimate value being 8 lakhs 58. 8 lakhs 58,000. For R, here 9 lakhs 26,640. From here you have to subtract the cash outflow. Cash flow outflow at the 0th period being, in case of machine R, we spent 2 lakhs. In case of machine S, it cost us me pretty higher by 2.5 lakhs, so 2.5 lakhs. Now your NPV for R, your NPV being 6,58,000. In case of S, your NPV being 6,76,640. Between these two, you have to choose this one, not this one. You have to choose this one, not this one. Is that clear? Question number 16. Also, one more example for the replacement of machine. A product is currently manufactured in a plant that is not fully depreciated for the tax purposes and has a book value of rupees 60. This is all about old machine, old one. Old one's book value being 60,000 rupees. It was bought for 1,26 years ago. Okay. Original value being 1,20,000 rupees almost 60 years ago, or this is the book value by the end of 60 years. This is original value at the 0th period. Okay. The cost of the product is as under variable cost as well as fixed cost. Okay. Variable cost as well as fixed cost. Okay. Per unit. Per unit. This is 48. This one is 16. Overall 64. For the old machine. 10,000 units are normally produced. Capacity being 10,000 units. It is expected that the old machine can be used indefinitely into the future. Though the machine is old one, 6 years is already over, still it will work for any number of years. After suitable repairs are carried out, estimated cost being 40,000 annually. But as this is being the old one, we have to spend the cost for the repair, which is 40,000 rupees every year. This is per annum. Okay. Similarly, a manufacturer of machine is offering a new machine with the latest technology at a cost of rupees 3,30,000. Now, new machine comes. Today's rate 3,30,000. If you want to shift from old to new, though the old is capable of working for further period, but you tempted to go for the new model, so the new model has come. But for the new model, you have to spend 3,30,000. Okay. Now, other costs. Always remember these information will help you to solve the illustration without referring the questions again. Whenever you solve the illustration, immediately make a note of the things given. Okay, given information. Post everything as soon as possible. In case of new machine, the variable cost is 38, fixed cost 20, the overall cost being only 58. The fixed overheads are allocated from the other departments plus depreciation of the plant and machinery. Of course, this includes the depreciation also. Okay, this fixed cost. The old machine can be sold for rupees 40,000 to the supplier of the new machine. So if you want to replace, in case of replace, the scrap value by selling this, you will get 40,000 rupees by replacing. The new machine is expected to last for 10 years. The remaining life being 10 years. What about the life of old machines are indefinitely? We assume it is also working for 10 years. Right. At the end of the period, its salvage value will be 20,000 rupees. Scrap value being 20,000 rupees. Okay. 20,000 is the scrap value by the end of 10th year. Now, rate of taxation is to be taken 50%. For the tax purposes, the cost of the new machine and old machine may be depreciated uniformly over the 10 years. For the taxation purpose, new machine and old machine can be depreciated over the 10 years period, right? From this, it is very clear the amount of depreciation in the very second case being 3 lakhs 30 minus 2 lakhs 20 divided by 10. 3 lakhs 10 divided by 10 being 31,000 will be the depreciation per year if you go for installing the new one. If you continue with the old one, the depreciation could be only 6,000. Only 6,000 like. Is that okay? Book value being 60 will work for another 10 years, then approximately the value being 6,000. Is that okay? 10 years. This is not scrap value, this is a replacement value. If you want to replace, you hand over the old machine and get the new one. By the time, if you are handing over today itself, you will get 40% rupees. If you don't hand over, we are not sure how much it will be recovering by the end of 10th year. We assume zero value will be there. Okay. And the minimum rate of return expected being 10%. KO is equal to 10%. It is anticipated that in future, the demand for the product will stay at 10,000 rupees, 10,000 unit. Currently, our capacity is 10,000. In the coming days also, we will have the same demand in the future. Considering the relevant costs, advise whether the new machine can be purchased or not. Ignore capital gains tax. If I sell the old assets, of course, asset being a capital asset, on selling, you will get either capital gain or loss. That can be having some impact of capital gains tax. So, it is clearly stated, you no need to consider that part. At final level, of course, you have to consider that one also. Okay, not at inter level. Clear? Let's now solve this illustration. Now, how to solve? You are shifting from old to new. What is the cash flows? What is the cash flows because of shifting from new one to old one? That's how you can work out here. Now, tell me. There is no sales revenue, only costs are there. So, variable cost 48. And for 10,000 units, what is the overall variable cost? 4 lakhs 80,000. Am I right? This is for old machine. In case of new machine, 38,000 into 10, 3 lakhs 80,000 rupees. Now, you forget about the fixed cost because it's only allocation. This fixed cost is not exclusive for the machine. It's allocated from the common costs. Fixed overheads are allocated from the other departments, plus the depreciation of the plant and machinery. So we have the depreciation also, fixed cost. Clear? Allocated means already there is a cost. Whether you use this machine or not, this cost is incurred, to be incurred. Right? So as we fix the machine, immediately we allocated the cost for the machines like. Okay. For example, if I charge for running the Singer Academy, I spend around 10,000 rupees rent for this room. If I recover from you, what will you tell? Sir, we are attending only in the evening. What about the morning batch, sir? What about the other batch, CMA batch, sir? You will ask lots of questions. Group 1 batch. This 10,000 for all? No. How will I say this 10,000 only for you? I will tell you the 10,000 rent I am paying only for these 6 students. In the earlier batch, I am paying this 10,000 only for this batch. The morning, I am saying, I am paying this 10,000 only for this batch. If I recover that amount, then it seems to be cheating, right? The same happens here. Whether you attend or not, you join or not, I have to pay the rent. So that is irrelevant for this purpose. So this is irrelevant for us. This 16 and this value is irrelevant. It's only allocated. Whenever it is stated as allocated, never bother about that one. Never bother about that one. Then variable cost. Apart from that, you have to spend for repairs. Repair cost you spend only for what? Old one. Fresh one has no repair cost. You no need to bother about that. Right. Now, what about the depreciation? Depreciation in this case being 6,000, here being 31,000. Then what about the total cost? 5 lakhs 26,000. 2 lakhs 5,500. 3 lakhs 4 lakhs 11,000. So okay, 4 lakhs 11,000. 000. Now, this is total cost or 5 lakhs 11,000. 4 lakhs 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000. 11,000 before tax. Okay, profit before tax may be negative. May be negative. Now profit after tax. What about the profit after tax? You have to multiply this with 1 minus t. T being 0.5, 1 minus 0.5, 0.5. So 5 lakhs 26,000 into 0.5, 2 lakhs 63,000, 2 lakhs 5,500. Negative. Negative. Profit after tax also negative. Now to get the cash inflow, you have to add the depreciation back. Depreciation in this case being 6,000, here it is 31,000. Already PAT being negative, if I add the positive number with that, so the ultimate value, the cash outflow, we don't have the inflow, only outflow. Outflow being 2,57,000. In this case, 1,74,500. 1,74,500. All are outflows only. If there is outflow, there will be tax saving. So I subtracted the tax saving. After the tax savings, I got the PAT. The PAT may be negative, so I am adding the depreciation back, which is the positive number. So from the negative number, if I subtract, then I will get negative outflow. So negative is nothing but cash outflow. I can name this being cash outflow. Right. Now tell me. Okay. Now tell me here. Because of moving from old to new, what about the savings, sir? The difference between these two is your savings, 82,500. Am I right? 82,500 will be your savings considered as revenue. Consider as revenue. Okay. In case of replacement model, suddenly you have to calculate the incremental cost, incremental revenue, incremental savings are down. The cost of running using the old machine being 257, new machine costing only this much. So you save alone 82,500. So the seller will demand you, sir, shift your old machine, go for the new machine. Because of shifting from old to new, you can save 82,500 rupees per year. For how many years? 10 years. Then what about your savings in present term? You have to multiply with the annuity factor. Is that okay? So you have to find out the annuity factor for 10% for 10 years. Yes, come on, tell me the annuity factor, the rate of 10% for 10 years. Hope this value being 6.144. So I have to multiply this with 6.144. The savings in this case being 5 lakhs 6,880. Apart from that, you will get the scrap value also. If you hold or if you shift from old to new, you have the scrap value of 20,000 rupees you are getting by the time of nth period, means 10th year. So for that, you have to use a PV factor at the rate of 10% for 10 years. The PV factor for 10% for the 10th year being 0.386. So if I multiply 20,000 with 0.386, that scrap value being, in terms of today's value, 7,720. The overall cash inflow. The overall cash inflow. What's that value? Come on. 5 lakhs 14,600. From there, I had to subtract the cash outflow at 0th period. What is the cash outflow here? Shifting from old one to new. Okay. You have to purchase cash outflow for purchasing the new one. How much? You have to pay 3,30,000. And cash inflow from selling the old one. How much? You will get 40,000 rupees. That's scrap value given. No, if you are replacing today, what value you can sell? You can sell for 40. So from this, it is very clear. If you spend 2,90,000 additionally, you will get 5,14,600 additionally over the period. So it is always the incremental cash outflow minus means compared with the incremental cash inflow. If the incremental cash inflow is better, then you can recommend replacing. Okay, the difference between these two is your net present value. Of course, it is positive. This value being 2,24,600. As this is being the positive, you can recommend. Okay. So when it is all about moving from one to next, you need to find out the cash inflow and outflow for the incremental basis. From moving from here to here, what is the extra cost or extra revenue? Is that okay? You cannot calculate the cash inflow and outflow independently for old and new. Clear? Now, certainty equivalent approach. In case of capital budgeting, everything is only expectation. If I buy this asset for 10 lakhs, this will give me returns 2 lakhs rupees for 6 years. Clear? Now the question is it clear? Is it sure? No. If you study 3 hours a day, you will score 20 marks in your exam. If you double your preparation 6 hours, you will score 40 marks. Triple your preparation, you will score 60 marks in all paper. Is it sure? No, sir. We expect so. Then how can you consider the exact mark you can score? 60 around and an average we have seen since very long ago. So 60 is an average. Some people may score 70. Some people may score only 50. But anywhere between 50 to 70. Okay then. Guarantee 50, right? Yes. We'll take the 50. So rather than expecting yourself being 60 or 70 or 65, what is the minimum possible assured mark or assured result you will get? That is called certainty. That's all. Okay. The Globe Manufacturing Company Limited is considering an investment in one of the two mutually exclusive proposals, Project X and Y, which requires cash outlay of 340 and 330. Project X has outlay of rupees 340, Y has outlay of 330. Certainty equivalent approach is used. What's that? CE approach is used to incorporating risk in capital budgeting. What about the expected cash inflow because of investing in these two projects, sir? Maybe 1 lakh, 1.5 lakhs, 3 lakhs. Sure? No, sir. At least tell me a sure value. So 1 lakh in optimum sense you can get, but rarely it may go down also. Probably guarantee 70. Minimum you'll get 70, sir. Maximum you get so much. Okay. What the minimum I expect now? That's the base for my calculation. That's all. Okay. So what happens when you go for writing the exam? Immediately after the exam, what will do? If you come to home, okay, you always give the mark for all the answers you have written. Always the very first time, what happens? You always start with strict evaluation. Okay, for this question, 4 marks. For this question, 5 marks. For this question, 3 marks. For this question, 0. If you count, it comes around only 20. Oh my God! Then immediately for this 10, for this 15, for this 7, then it comes 70. Oh, exemption. No. Then only you come back to a static number to allot yourself to guess. That's what about the expectation. Worst scenario and best scenario. What is the most favorable or uniform scenario? That is what about expectation. So you will just adjust that one using the certainty equivalent approach, right? Rest of the things are the same, like. And the current yield on government bond is 8%. What does it mean? This may be considered as cost of overall capital, and this be used as a riskless rate. Right. The expected net cash flows and their certainty equivalents are there. So here we'll start with Project X. Project X. Okay. For the Project X, what about the cash inflow? Cash inflow for year 1, year 2, year 3 given. Year 1 180, though 180. How much is guaranteed, sir? Sir, 0.8 is guaranteed, sir. I will consider only the certainty value or certain cash inflow will be considered, which is nothing but cash inflow is multiplied with certainty equivalent. So 1,80,000 into 0.8, what is the value? 1,44,000. If I ask you, will you be able to get 1,80,000, sir? Rarest scenario, sir. Okay, in case of worst scenario, guarantee, sir, at least you will get 144. At least you will get 144, no? That is what about certain. You will consider the certainty value for the deterministic cash inflow for the calculation in case of worst scenario. 2 lakhs into 0.7, 1,40,000. 2 lakhs into 0.1, 0.5, 1 lakh. Now, what about the PV factor at the rate of 8%? 8% P factor. It's not KO, it's RF, risk-free rate of return. RF and KO are not same. RF and KO are not same. RF represents risk-free rate of return. I use this term in detail along with the cost of overall capital calculations, along with the dividend calculation and all. RF is nothing but if I invest only in the bank, government securities safely, invest and sit ideally without any tension, how much will I get? That is called RF. Guarantees are you will get 6% or 7%. Government capable of giving only this much. So 24% I expect go to the share market. 240% sir, no problem, go to Bitcoin. Where do you want? Higher the return, higher the risk. If the business is always riskier, no, so you demand something extra. So the RF being 8% means KO may be 14%, maybe 14%, because for the risk also you demand some extra return. Okay, 8% for the bank rate. As I'm not investing in the bank because bank has guaranteed return of the money, I'm investing the risky proposal. So give me some extra 6% for taking the risk. In this case, the cash inflow is adjusted for the risk using the certainty equivalent. So we are taking the RF, not KO. In some cases, if RF and KO both are given, if you are using the CE model, better you can take the RF. Better you can take RF. Is that okay? Clear? You can note it down. You can note it down. So what is the P factor that of 8%? Probably 0.926, 0.857, 0.794. Now find out discounted certain cash inflow. You have to multiply certainty cash inflow, certain cash inflow with the P factor. So this value being 1,33,344. Here 1,19,980. Here 79,400. Overall value being 3,32,724. Summation of discounted certain cash inflow. From there, cash outflow can be subtracted. The cash outflow of the project X being 3 lakhs 40. Investing 3 lakhs 40, but you are getting only 3 lakhs 32,000. Certainly. Anyhow, it is negative only in case of worst scenario. 7,276, you will be getting negative. As per the NPV criteria, this project should be rejected. In case of project Y, you have to find out certain cash inflow, certain deterministic cash inflow. So you have to multiply the CIF with the CE. Then this value being 1,62,000, 1,44,000, 1,40,000. Now discounted certain cash inflow. You have to multiply this with PV factor. The PV factor being this one. So you multiply these two, you get 1,50,000, 12 rupees, 1,23,000, 408, 1,11,160. If you add up the three, the ultimate value being 3,84,580. Your investment in this project being only 330. You invest 330, but you get 3,84,000, almost 54,580 excess. Even in worst scenario, definitely you can accept this one. You can accept. Reject project X and accept project Y. That's all. This one adjustment, 2 point. One is whatever the cash inflow we predict, we now have doubt whether will it be real or not. So realistically, some value may be adjusted now. For adjusting, we need to multiply with the CE. 0.8 means 80% is guaranteed. 1 lakh, will it come? At least 80% guarantee. That at least 80% is the certainty equivalent. As for the risk, we have removed this one by using the certainty equivalent. Cost of capital also, where risk is removed, we will be taking only RF, risk-free rate of return. Risk-free rate of return. Clear? Now, the last one, adjusted net present value method. This adjusted net present value, the next method is not applicable for the CA students. Okay. Now, a firm is considering a project requiring 50 lakhs of investment. Expected cash flow is 10 lakhs per annum, cash outflow being 50 lakhs. Expected cash flow being 10 lakhs per annum for 8 years, cash inflow being 1 to 8 years. You get 10 lakhs each. This is outflow at 0th period. The rate of return required by the equity invested from the project is 15%. The rate of return expected by the equity shareholders, named as cost of equity, in short KE, 15%. The firm is able to raise 24 lakhs of debt to finance carrying 14% interest of the project. Apart from that, they can raise the fund by debt form. For that, 14% will be the cost. The amount raised using the issuing the debentures and other thing being 24 lakhs. So usually up to now we have seen only cost of overall capital, KO, cost of cut-off rate. But here we have KE and KD. Sir, I am not familiar with the term KE and KD. No need to worry about that. Once you finish up cost of capital chapter, this chapter is very easy. This terms is very easy. Where how can we calculate the KE, KD, KR, KP and all? There you study everything in detail. Okay, that's most important chapter. For understanding that KO chapter, you need to be master with the time value of money. 1.2. All these things are sequential. Okay, so we'll see that later on. The debt is repayable in equal annual installment over 8-year period. This will be repayable in 8 installment. The first to be paid at the end of first year. That applicable tax rate being 40%. You are required to calculate not NPV, adjusted NPV. Assume flotation cost, assume equity cost, equity issue cost, otherwise named as flotation cost, being 5%. So if you want to issue the shares, you need to call for brokers, underwriters, promote yourself giving the advertisement. All these things are also involving some cost. For issuing 100 lakhs rupees equity share, you need to fix lots of brokers and collection agent and all. For that, 5% will go off. So you will get only 95 lakhs. That's all about the term equity issue cost. Now, in this case, you have to first calculate the base NPV. Base NPV. Base NPV is nothing but you don't have any borrowings. You collected the full money by issuing the equity shares only. That's called base without debt component. In that case, you will be getting how much? Cash inflow being, discounted cash inflow being, every year you are getting 10 lakhs. Find out the annuity factor. Okay. Cash inflow with the annuity factor at the rate of 15%, because we never bother about this one. 15%. Yeah, come on. Hope this value being 4.4873. What is the final value? I think 4 lakhs 87,300 minus cash outflow at 0th period. How much you have to invest? 50 lakhs you have to invest. So your inflow is lesser. So your NPV in this case is equal to 5 lakhs 12,700 negative. This is called base NPV. If you want to raise the full required fund only by issuing equity shares, this is what about your NPV? NPV negative. Okay. Now remember, this annuity factor is found out for KE. That means 15% for 10 years. Am I right? 8 years. Am I right? Isn't it? If the rate rather than being 15, if it is 14, what happens? This value will be higher. If this value will be higher, there is chances of a positive NPV also. Am I right? So if the cost of equity is decreasing, the discounted cash inflow will be increasing. Sometimes later this may be higher than the cash outflow will give us positive NPV also. Now, rather than issuing the shares and collecting the requisite fund by issuing the share, costs me 15. There is one more source of fund which is KD where it is cheaper, only 14%. Not only that, because of repaying the debt, what happens? Because of repaying the debt, interest will be there. That interest is debited to the P&L account. By debiting the interest to the P&L account, profit will go down. For the reduced profit, you pay the lesser tax. There's a tax savings. Okay. So if you are including the debt component also for financing this purpose, there will be some chances that cash inflow is higher than the cash outflow. So that NPV may be possible. Calculation of that one by including the debt component, we can find out one more NPV. That NPV is called adjusted NPV. The NPV what we have calculated is the base NPV. After including the capital structure change, rather than only equity share, we add some debt component also. If you find out what is a new NPV, then that will be called as adjusted NPV. In case of adjusted NPV, okay, you have to understand this one. Adjusted NPV is equal to base NPV minus cost of issue of equity shares plus savings due to the debt. If you borrow, then there will be savings. No, you have to find out that. Let me calculate this one after one. Base NPV is this one, 5 lakhs, 12,700 negative. What about the cost of issue? 5% is cost of issue. If the equity share capital is 100, you have to pay for expenses, cost of issue. 5%, 5 rupees will go. You will get only 95. This is what about net consideration you get by issuing the shares. How much you need? You are in need of 50 lakhs rupees. As you plan to go for funding a part from KD, another part should be by way of equity shares. You need 26 lakhs should be in your hand by way of equity shares collection. So for every 100 rupees, you will have only 95 rupees in your hand after the expenses. So I am in need of 26 lakhs. 26 lakhs. Now if I do the cross multiplication, how much share I have to issue? What is the cost of issue? I think the cost of issue should be 1,36,842. This value being 27 lakhs. 27 lakhs, 36,000, 27 lakhs. Okay, this value 27 lakhs, 36,842. So though you are in need of equity shares only 26 lakhs, if I issue only for 26 lakhs, I have to pay the brokerage and other commission, so I end up with a lesser amount. But by way of equity share itself, my collection should be 26, means how much of face value should be there for the issue. And the cost also, so that you will get in a reverse calculation, 5 by 95. So this 1,36,842 will be the cost of issue of equity shares. Also loss, 1,36,842 is also loss. By moving to the debt component, you will be saving the tax. Is that okay? That tax savings can be added here. So I have to find out the tax savings separately. Okay, so I will finish up calculating that one here. Tax savings. Actually, the borrowing is, loan is 24 lakhs. And the cost of debt for this being 14%. What about equated annual installment? What about the equated? Okay, the entire loan is repayable in 8 years along with the interest equally. Now you have to find out the equal amount, not along with the interest, equal amount. So this entire 24 lakhs is payable in 8 years equally. So the equal amount every year you are paying is 3 lakhs. So now see here 0, 1, 2, 3, 4, 5, 6, 7, 8. Okay. And what about the debt balance? Debt balance. At 0th period, in the beginning you issued and collected 24 lakhs. Every year you are repaying 3 lakhs. So first year you then end up with only 21 lakhs, then 18 lakhs, 15 lakhs, 12 lakhs, 9 lakhs, 6 lakhs, 3 lakhs. 8th year, oh, do I make any error? Okay, okay. So the loan is repayable by the end of first year. So first year end, you have 24 and becomes then 21. So 21, 20, 18 and 15, 12, 9, 6 and 3. Now what could be the interest payable? Interest payable being whatever the debt balance you have, for that you have to pay at the rate of 14%. In the very first year, 24 lakhs is pending. For the 24 lakhs at the rate of 14%, what is the value? 3.36 lakhs. Next, 2.94 lakhs. Next, 2.52 lakhs. Next, 2.1 lakh. Next, 1.68 lakhs. And next, 1.26 lakhs. And next, 0.84 lakhs. Finally, 0.42 lakhs. Okay. Because of this interest payment, you save the tax. Okay, that will be your gain, right? Tax savings. Tax savings will be your gain. What is the tax savings? 0.5. By debiting this interest, your profit will decrease. If you are paying to the equity shareholders dividend, you have to pay only after payment of tax. After payment of tax, whatever the leftover is for the equity shareholders. Post-tax profit could be used. In case of interest payment, it's a charge or expenses can be debited to the P&L account. By debiting that to the P&L account, your profit will go down. For the reduced profit, you pay less tax, but not for the equity share dividend. So that's why whenever we debit the interest, we save the money. That savings will be now considered for our benefit. So at the rate of 50% savings is there to the extent of T. This value being 1.344, isn't it? 40% tax rate. So 40% tax rate. Okay, tax rate being 40%. Okay. So 1.344 and 1.176, 1.008, 0.84 and 0.672, 0.504 and 0.336, finally 0.168. And you have to find out the present value of all the tax savings by applying the PV factor here. PV factor at the rate of 14%. Debt component, no? For that, KD will be applicable, KD being 14%. 14% PV factor being 0.877, 0.769, 0.675, 0.592, 0.519, 0.456 and 0.4 and 0.351. Now find out that discounted tax savings. Tax savings. You have to multiply these two to get the discounted tax free savings. 1.179 and 0.905, 0.680, 0.497, 0.349, 0.230, 0.134, 0.059. And summation of the entire tax savings being 4,03,333. That will be addable here, 4,03,333. So you have to find out the base NPV using only the KE. Thereafter, from the base NPV, we have to do slight adjustment for the cost of issue of equity shares as well as savings in the in the interest, tax savings on the interest. So, ultimate value being minus 2,46,209. Even the base NPV is also negative, as well as the adjusted NPV is also negative. So, we no need to recommend this project. Okay, and also this one has least important for your examination, right? So you just have the idea of this one. Beyond that, nothing is required. So with that, investment management is completely over.